Imagine waking up one morning to find out that your entire life savings has vanished. Your retirement account, gone. Your job, eliminated. Your home, worthless. Now imagine this happening to millions of people simultaneously, all because of a lie so devastatingly simple it could fit on a single billboard. Why rent when you can own? September 2008. A 158-year-old banking institution collapses overnight. $600 billion evaporates into thin air. The global economy teeters on the edge of total annihilation. But here's what nobody talks about. The real catastrophe didn't start with complex financial instruments or Wall Street greed. It started with ordinary people being sold a dream that was designed to fail from the very beginning. This is the story of how America's housing market became a weapon of mass financial destruction, and why everything you thought you knew about the crash of 2008 is probably wrong. Let's rewind to 2002. Picture this. America is still stumbling through the aftermath of the dot-com bubble burst. The tech boom has gone spectacularly bust, leaving investors burned and the economy shaky. Then 9/11 hits like a sledgehammer, sending shockwaves through every sector of American life. Wall Street is nervous, twitchy, looking for the next big thing to restore confidence and get money flowing again. Enter the Federal Reserve with what seems like a brilliant solution. They slash interest rates down to practically nothing, making borrowing cheaper than it's ever been in modern history. Suddenly, money is flowing like water from a broken dam. Banks are practically begging people to take loans, and the American public, hungry for stability and prosperity after years of uncertainty, finds a new obsession. Forget baseball, forget apple pie. The new American pastime is buying houses. Real estate became the golden ticket, the sure bet, the one investment that supposedly never fails. Here's where things get wild. You walk into a bank making $40,000 a year, barely scraping by, and somehow you walk out approved for a $500,000 mortgage. Sounds insane, right? It was insane, but banks didn't care about your income anymore. They had invented something called a ninja loan. No income, no job, no assets. No problem whatsoever. If you could fog a mirror, congratulations, you qualified for a mortgage that would make your grandparents faint. The early 2000s transformed homeownership from a practical financial decision into a cultural fever dream. Every advertisement, every billboard, every late-night infomercial hammered home the same message. Owning a home wasn't just smart, it was your patriotic duty. It meant you'd made it. You were stable, successful, living the suburban dream with a white picket fence and granite countertops. The pressure to buy wasn't subtle, it was everywhere, relentless, turning an entire generation into house-hungry zombies willing to sign documents they didn't understand for properties they couldn't afford. Banks weren't just agreeing with this madness, they were orchestrating it like a twisted game show where everyone appeared to be winning. This is when subprime mortgages exploded onto the scene like a financial plague. These were loans specifically designed for people with terrible credit, unstable income, or frankly, no business taking on massive debt. Living in a van? Perfect. Here's approval for a luxury condo. Never held a job for more than 6 months? Wonderful. Sign here for your dream home. The sales pitch was seductive and sinister. Don't worry about paying it back. If you default, we'll just sell the house for more money. Housing prices always go up. It was presented as a risk-free proposition, a golden opportunity that only suckers would pass up. The entire country got swept up in a housing gold rush that made the California gold rush look tame by comparison. Prices weren't just rising, they were skyrocketing at rates that defied all logic and historical precedent. Your neighbor's 3-bedroom doubled in value in 6 months, and nobody questioned it. McDonald's workers and part-time baristas with $5 in their checking accounts were getting approved for mortgages that would take decades to pay off. Traditional lending standards launched straight out the window like yesterday's garbage. Risk assessments were considered boring, old-fashioned, obstacles to profit. Down payments became optional, almost quaint suggestions from a bygone era. Documentation? Who needs it? The only requirement was having a pulse and the ability to sign your name on a dotted line. People started buying houses the way college students buy ramen noodles, in bulk and without thinking. Lenders were printing loans like they were playing Monopoly with real money. Mortgage brokers were raking in commissions so fast they couldn't count it all. And underneath all this frenzied activity was one fundamental assumption that everyone believed with religious certainty: housing prices would always go up. They had to. They always had, until they didn't. But in those golden years before the crash, questioning the boom was heresy. Anyone who expressed doubt was dismissed as a pessimist, a party pooper who didn't understand the new rules of modern economics. What could possibly go wrong? Spoiler alert, absolutely everything. By 2005, something had fundamentally shifted in the American psyche. Buying a house was no longer about finding a place to live, to raise a family, to build a life. It had become about flipping properties like pancakes and praying the next buyer would pay double what you did. Real estate stopped being shelter and transformed into lottery tickets. The stories became increasingly absurd and terrifying in their stupidity. Elementary school teachers buying 3 condos with 0 money down, not living in any of them, just holding them like stocks waiting to appreciate. Baristas getting phone calls from banks offering them penthouses in Miami while they were literally steaming milk. This wasn't investing in any traditional sense. This was a national gambling addiction dressed up in financial terminology. The mechanism was simple and destructive. Buy a property, flip it quickly for profit, repeat until you're rich. And the more people who jumped in, the higher prices climbed. The higher they climbed, the more people rushed in like moths to a flame. It was a self-reinforcing cycle of madness, like trying to extinguish a raging fire by dumping gasoline on it while everyone stood around with matches. But underneath the hot rod exterior of boom times and easy money, something rotten was festering. Those subprime mortgages that everyone was gorging themselves on were fundamentally toxic. High risk, low documentation, barely verified debt being handed out like candy on Halloween. But Wall Street, in its infinite creativity and greed, had developed a magic trick that would make Houdini jealous. They took all that garbage debt, bundled it together into complicated packages, slapped official-looking labels on it, and sold it to investors around the world as safe, reliable investments. Welcome to the world of mortgage-backed securities, now with 80% more lies than regular financial products. The con was elegant in its simplicity. How do you make toxic loans look like gold? Easy. You get the ratings agencies, the supposed watchdogs of financial safety, to rate them AAA, the same rating given to the safest investments in the world. Imagine a bundle containing mortgages from bankrupt baristas, unemployed gym bros, and people who lied about every line on their application. The ratings agency looks at this steaming pile of financial refuse and declares it perfectly safe for pension funds and retirement accounts. Here's the part that should make your blood boil. The ratings agencies were getting paid by the very banks whose products they were rating. It's the equivalent of hiring a food critic to review your restaurant and then telling them they only get paid if they give you 5 stars, even if you're serving raw chicken. The entire system was designed for corruption from the ground up. Behind closed doors, the raters knew these bundles were garbage. Internal emails later revealed they understood exactly how risky and fraudulent these products were, but the money was too good, the pressure too intense, and the consequences for honesty too severe. So they stamped their approval and cashed their checks while the fuse kept burning. But Wall Street wasn't satisfied with just one layer of deception. They took those shaky mortgage bundles and blended them into something even more complicated and incomprehensible: collateralized debt obligations, or CDOs. Through financial alchemy that would make medieval wizards proud, they transformed garbage loans into investment-grade assets that pension funds, insurance companies, and foreign governments eagerly purchased. The house of cards grew taller and more unstable with each passing day. Not everyone was fooled by this elaborate con game. A small handful of investors, oddballs and skeptics and troublemakers who actually read the fine print, saw through the smoke and mirrors. They examined the fundamentals and realized the entire structure was rotten to its core. Instead of buying in and riding the wave, they asked a question so bold it seemed crazy. What if we bet against it? What if we profit when this whole thing collapses?
The problem was that no financial product existed that would allow them to short the housing market in a meaningful way. So they marched into Wall Street's marble fortresses and made an audacious proposal. These loans are garbage. We want to short them. Can you build something that pays us when they inevitably fail? The Wall Street bankers laughed in their faces. Betting against housing? That's adorable. That's like betting against the sun rising tomorrow. But then greed kicked in. Wall Street smelled easy money. They didn't believe these investors for a second, but they loved the idea of collecting steady monthly fees on insurance policies that supposedly never would pay out. So they got creative and invented the financial weapon that would eventually detonate and nearly destroy the global economy: credit default swaps. These were essentially insurance contracts that paid out if mortgage-backed investments went bad. But here's where it gets truly insane. You didn't actually have to own the underlying investment to buy insurance on it. It's like buying life insurance.
At first, the collapse came as a whisper. A missed mortgage payment here, a foreclosure notice there, a condo in Las Vegas sitting empty with a for sale sign slowly fading in the desert sun. But whispers became murmurs, and murmurs became roars. Suddenly, the unthinkable was happening right in front of everyone's eyes. Home prices were falling. After years of being told that housing always goes up, that it's basic economics, that betting against real estate is like betting against gravity, the impossible was occurring. For years, the housing market had been a Jenga tower made of lies, leverage, and wild optimism that defied reality. But in 2007, someone pulled the wrong block, and the whole structure began to wobble. Those subprime loans, the risky, rotten deals that had been wrapped in financial tinsel and sold as safe investments, started imploding like a chain of controlled demolitions. And the mortgage-backed securities built on top of them, those were ticking time bombs, and they were all exploding simultaneously across the financial landscape. Banks that had proudly stuffed their portfolios with what they thought were safe AAA-rated assets suddenly realized they were holding radioactive garbage that was destroying their balance sheets from the inside out. The supposedly safe bundles were actually financial plutonium melting down in real time. Panic gripped the financial world as institutions frantically tried to sell their toxic assets, only to discover there were no buyers at any price. The market had gone to zero overnight. Hedge funds were bleeding billions. Investment banks were slashing their valuations and watching their stock prices crater. And then came the earthquake that changed everything. Lehman Brothers, a 158-year-old institution that had survived the Civil War, 2 World Wars, and the Great Depression, collapsed into bankruptcy. $600 billion gone in a weekend. No government bailout, no white knight rescue, just a smoking crater in the middle of Wall Street that sent a message heard around the world. If Lehman can die, anyone can die. Overnight, the entire financial system seized up like an engine without oil. Banks stopped lending to each other because nobody trusted anyone anymore. Credit markets froze solid as if someone had hit a giant pause button on the global economy. The consequences rippled outward with devastating speed and force. Families couldn't get mortgages to buy homes. Businesses couldn't get loans to make payroll or buy inventory. Investors couldn't cash out their positions. Retirees watched in horror as their pension funds and 401k accounts evaporated in real time. Decades of careful saving disappearing like smoke. Life savings accumulated over entire careers vanished. The job market didn't just slow down, it vaporized. By late 2008, the United States had entered full economic collapse mode. Millions found themselves suddenly unemployed. Foreclosure notices stacked up like junk mail. Eviction signs appeared on doors across suburban neighborhoods that had symbolized the American dream just months earlier. Soup kitchens couldn't keep up with demand. Unemployment offices looked like disaster relief camps after a hurricane. This wasn't just Wall Street burning anymore. This was Main Street in complete freefall. Ordinary people who had played by the rules suddenly finding themselves homeless, jobless, hopeless. And the disaster didn't respect borders or oceans. Iceland's major banks collapsed, taking down the entire nation's economy. Tokyo stock markets plummeted. European leaders scrambled desperately to prevent contagion. From London to Reykjavik, Tokyo to Sao Paulo, markets crashed,
Banks buckled and economies spiraled downward in a synchronized global catastrophe. The Great Recession had officially begun. The United States government faced an impossible choice that would define a generation's relationship with capitalism and fairness. They could let the entire financial system burn to the ground and face another Great Depression, or they could throw billions of taxpayer dollars at the very people who had started the fire in the first place. In October 2008, they chose the latter option. $700 billion for the Troubled Asset Relief Program, basically shoveling taxpayer money into burning banks before the whole economy exploded like a financial nuclear bomb. The justification was coldly logical. These banks weren't just big, they were too big to fail. Let them collapse and they would take down the entire global economy, destroying millions of innocent lives in the process. So the government started throwing money around like it was going out of style. Loans, bailouts, stock purchases, whatever form was necessary to keep the zombie banks shambling forward. It wasn't just commercial banks getting the golden parachute treatment either. AIG, the insurance giant that had made trillion-dollar bets on garbage mortgages, received over $180 billion in aid. Even car companies like GM and Chrysler got $80 billion to avoid bankruptcy. Meanwhile, Ben Bernanke at the Federal Reserve was busy rewriting the entire playbook of monetary policy with what essentially amounted to a money cannon. Interest rates were sliced to near zero, making borrowing basically free for those who could still access credit. Then came the truly unprecedented move, quantitative easing, which in plain English meant the Federal Reserve started printing money out of thin air to buy bonds and mortgage-backed securities that nobody else would touch. It was like trying to patch the Titanic using $100 bills as sealant. And here's the crazy part, it kind of worked, at least for Wall Street. Markets calmed down, banks unclenched their death grip on assets, the stock market hit bottom in March 2009 and started crawling back upward. Wall Street exhaled and started planning for their next bonus cycle. But while the financial sector was recovering and celebrating, Main Street was still choking on smoke and struggling to breathe. The aftermath was absolutely brutal for ordinary Americans. Unemployment hit 10%, with 8 million jobs just vanishing from the economy. 4 million homes were foreclosed, families thrown out onto streets. $19 trillion in household wealth evaporated like water on hot pavement. Families that had never missed a payment in their entire lives suddenly owed more on their homes than the homes were worth, trapped in a nightmare scenario called being underwater. And people were righteously and furiously angry. Wall Street bonuses came roaring back by 2009, while people who had just been evicted watched executives celebrate their successful year on television. The people who caused the collapse got bailouts and bonuses. The people who lived through it got pink slips, foreclosure notices, and food stamps. Wall Street popped champagne in penthouse offices. Main Street stood in line for soup kitchens and unemployment benefits. The rage built slowly and then exploded in 2011 when thousands gathered in Zuccotti Park in New York City with tents, drums, and cardboard signs. One sign captured the moment perfectly: "We are the 99%. It wasn't just about bailouts anymore. It was about a system fundamentally rigged to protect the powerful while sacrificing everyone else. Privatized profits and socialized losses had become the American way. And what made people angrier than anything was the complete absence of justice. Not a single major Wall Street CEO went to jail for their role in nearly destroying the global economy. No handcuffs, no perp walks, just golden parachutes worth millions and quiet retirements to private islands. The system survived, barely, held together with bailout money and emergency policies, but trust burned completely to the ground and has never fully recovered. An entire generation grew up learning a harsh lesson about how America really works. When banks mess up catastrophically, they get rescued with taxpayer money. When you mess up even slightly, you get wrecked. The 2008 financial crisis taught us that the game is rigged, that the people at the top play by different rules, and that consequences are only for the little people. But here's what should terrify you about all of this. The fundamental problems that caused 2008 were never truly fixed. The banks got bigger, not smaller. The regulations got weaker, not stronger. And somewhere right now, the seeds of the next crisis are already growing. Because if 2008 taught us anything, it's that the next crisis never looks like the last one. It looks harmless, profitable, and inevitable, right up until the moment it explodes in everyone's faces. The question isn't if it will happen again. The question is when, and whether we'll be ready this time, or whether we'll make the exact same mistakes all over again.